The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The elephant in the room, uncertainty about fiscal policy affecting decisions on monetary policy. Romaine Bostic here with Alex Seal and Scarlett Fu. This is The Close, counting you down to the closing bells here in this post-Fed special. The headline, of course, was that 25 basis point cut, guys, but I think everyone is focused on that dot plot, what it delivered, and more importantly, what it's apparently not going to deliver in 2025.
In terms of WIRP, we're not seeing a full cut priced in until September, and I'm just stunned by the market reaction, particularly in the Russell. I mean, the deterioration we've seen just in the last few minutes has been extreme. The Russell down by almost 5% at this point.
And, you know, it's no longer unanimous that there's some cracks in the foundation here with Cleveland Fed President dissenting in this 25 basis point cut. It really is going to make for some interesting debate in 2025 as well. Let's take a listen to everything that we learned from Jay Powell during his press conference.
The committee decided to lower the target range for the federal funds rate by a 1/4 percentage point. Committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. To cut further after this point, I would say it this way. We've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market.
Jay Powell speaking at that Fed press conference. And in fact, the extremes that we're seeing in the market, as Alex alluded to, one of the most extreme market reactions during a Fed press conference that we've seen in quite a few years. That 2.5% drop on the S&P, almost all of that coming post 2 p.m. Ken Shinoda joining us right now, portfolio manager with Doubleline Capital. And Ken, is not just the equity market showing extreme moves. We saw extreme moves in the bond market with the 2-year yield rising the most since at least October, and a 10-year yield having its biggest reaction to a Fed day in at least 4.5 years.
Yeah, I like to not look too much into the price action on Fed day because you have a lot of positioning going in and people have to unwind their hedges and their longs. But, you know, the Fed did what the market was pricing in. The market was pricing in going in today, almost 100% probability of a rate cut today, and then 2 more next year, 1 in the summer and 1 towards the end of the year. So it's kind of funny that you get such big moves when the market gets what it's priced in.
Right, Ken. So here's my big question. Do you buy the dip? My profound question.
Yeah, look, I think equities were very overvalued going into today. You've had a huge run. You saw breadth in the equity market start to deteriorate over the last couple of weeks. I saw strategists put out that it was the worst breadth in 11 trading days in the last 100 years yesterday morning, where most stocks were down and the Mag 7 was kind of holding the market up. So I'm not surprised we're seeing a correction in the equity markets. The bond market, we've seen this level before. In fact, we've seen worse than this. We saw 470 on the 10-year earlier this year. So we're just retesting the 450 level on the 10-year. It's a pretty critical point. We'll see if we get some buy the dip here. I think this does give investors a chance that want to add a little bit more interest rate risk or duration of the portfolio to take a bite of the apple here at this 450 area.
How contentious will the debate be in 2025? I mean, the first question in the press conference was, why cut today if there's such a cautious outlook for future rate cuts for elevated inflation? And Jay Powell admitted today was a closer call. That suggests that next year it's going to be, you know, a raging debate.
I think there is just, as you say, there's a lot of unknowns, and they have wanted to normalize policy today. As he noted himself, they're 100 basis points closer to the neutral rate. They don't know exactly what the neutral rate is, but at least they've made this move this year. And by pushing back next year's cuts to the middle of next year and the end of next year, that gives them a lot of time to get data in to help decide how they need to proceed. So they've just given themselves optionality. And the market doesn't like that. The market doesn't like that uncertainty.
Martin certainly doesn't like that uncertainty, and you're seeing that reflected on the screen. Just for our viewers, stocks continue to hit session lows. Bitcoin down 5%. The VIX now above 22. And Ken, I pose this question back to you. When it comes to uncertainty and maybe the potential for volatility going forward, how much should we make of the lack of consensus around this meeting. And I know we have to wait a few weeks to see the minutes here, but you're going into 2025 with policymakers clearly divided. That's clearly evident in the dot plot. No one seems to really know what the Fed should do next.
I think a lot of it has to do with the change in the incoming administration. There's so much uncertainty around what they're going to do fiscally, what are they going to do with tariffs, what's that going to mean for inflation. So it's not surprising to see so much dissent between the members. But time is on their side now. Credit spreads have come in while equities are down today. They're clearly near all-time highs. So I think the credit markets have loosened up, financial conditions that have improved, companies can borrow, even people in the real estate market can borrow again. So they're getting what they need for economic growth. They're just worried about a reacceleration in inflation now.
So if that's the case, what do you do in the bond market and the long end in particular?
Yeah, we like being underweight the long end. I mean, maybe not right quite the second after this big sell-off. I wouldn't be selling into today's pressure, but the fiscal risks are out there. There's a lot of talk about what's the right term premium. Is there going to be more bond issuance in the future? So generally speaking, we don't really like ultra long end exposure. And when I say that, I mean things like 30-year treasuries. But you can still put together a very attractive intermediate term or shorter term bond portfolio. And with this rise in the base rate, you can buy some credit assets, put them together, and get about a 6 to 7% yield. That's on par with long run equity returns, and that's positive real return after inflation expectations today.
Ken, based on what you heard today, what data point becomes the most important now going forward?
Well, I think it's a mix. I think inflation is obviously going to continue to be important, but they're closely watching the job market. That's what they were most concerned about. They've been recently alleviated with stronger jobs report in November. So I think they had stopped really looking at inflation so much, thinking that they had won that battle, and really they just needed to save the labor market. But now I think both those two things have reared their heads back into their minds.
Ken Shinoda over at Doubleline Capital. Thanks to him, and we'll catch up with him again in the new year, I'm sure, as we parse the market reaction, guys, to that big Fed decision. Of course, a reaction not necessarily to that 25 basis point cut, but more what it's forecasting for 2025.
Yeah, and really the question is, how are you pricing in any Trump policies? And you could see even from the Fed that some actually did say that they were looking at it, others didn't address it, and others said they weren't.
But then Powell keeps talking about, we're trying to look through this and look past it, and it's like, no one else is.
Right, exactly. Maybe you guys aren't on the same page, and it makes for an incredibly messy way of projecting what's coming ahead.
We have a lot to parse here as we move closer to the closing bell. Sit tight here. A simulcast coming up as we break down all of the market reaction in response to today's big Fed meeting. That's coming up now on The Close.
Hey, you got me with...
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Seal and Scarlett Fu taking you to the closing bell, a global simulcast. It starts right now. Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms here on a Fed day. 25 basis point cut. That was expected, Carol Massar, but an update to that dot plot taking a lot of folks off guard. You're seeing extreme moves right now in stocks, in bonds, and in the FX market.
Yeah, I mean, kind of across the board. I'm looking at something like housing stocks. They're down about 4% at this moment. Looking at bank stocks, they're down more than 4%. So, new narrative, reset. I don't know, but it definitely feels a little bit differently today.
The Russell 2000 is something I've been looking at closely because it's getting hit right now hard. It's down to levels last seen since before Election Day. So giving up all of those post-election results down to lowest since November 4th.
Yeah, I wonder how much of this selling will be sustained into tomorrow. We've been talking a lot about how, people were waiting for this as the last big event of 2024. Okay, it's come. How is this going to continue, or, starting tomorrow, everyone takes off?
Well, that's what I am curious about is, does this become that buy the dip moment, or are we kind of at the mercy of, I think what you're alluding to is just kind of seasonality, the idea that a lot of people are kind of moving away. A lot of people are going to book very large gains on this year, so why take any sort of unnecessary risk over the next, 4 to 5 weeks until the president's inaugurated? On
the other hand, though, in theory, why wouldn't you buy the dip? I mean, if Jay Powell said anything, he said that the U.S. economy is really strong, and it's much stronger than the rest of the world. That's why they revised their growth target up, why they had to revise their inflation forecast up a little bit, and we still are coming with cuts, just not in January necessarily.
A lot of questions, though, as to exactly why this move would be so extreme. We talk about an S&P 500 500, more than 90% of the stocks in that index are in the red. Remember, the last time we saw this type of extreme sell-off was back in early August when that carry trade blew up. And before that, you have to go all the way back towards the beginning of the year when there was a lot of concerns about recession risk. We get the closing bells in New York with the Dow Jones Industrial Average down by 1,100 points or 2.6%. The S&P 500 closing back below 6,000, down 179 points or 3% lower. The NASDAQ Composite down 700 points or 3.5%. The NASDAQ 100 down about 3.6%. And the Russell 2000, 103 point drop today or 4.4%.
All right, so just going through those averages, folks, you've got 483 names in the S&P 500 lower, so almost all of them remain. You just mentioned this. And Scarlett, if you go over to the NASDAQ 100, you've got 100 names to the downside, one to the upside. So you are seeing really some broad-based selling as we speak.
Yeah, it's pretty clear that the appetite for risk is not there today. You look at the IMAP and red all around, including when you break down the sectors into 24 industry groups as well. Still, it's notable that your outperformers and that they didn't fall as much as the overall S&P 500 are healthcare, consumer staples, and utilities, classic defensive sectors. Worst performers, consumer discretionary, real estate investment trusts, each down by 4%, and communication services losing 3.1%.
And your superlative on the day, the S&P falling its biggest post-Fed drop since March of 2020.
Yeah, we've also got some earnings crossing the Bloomberg terminal. We should just quickly mention Micron, certainly one of the names in the semi space. First quarter adjusted revenue, $8.71 billion. That is spot in line with what Wall Street was expecting. First quarter adjusted EPS, $1.79 a share. That's 3 pennies better. And then going to the outlook, the company says it sees a return to growth in the second half of the fiscal year and sees second quarter adjusted revenue, Tim, of $7.7 billion to $8.1 billion. And that is below the estimate of $8.99 billion. Stock
Look
down.
Look at this.
Yeah, almost
shares
12%.
down in the after hours, 12%, as Carol mentioned. Micron saying that consumer-oriented markets are weaker in the near term. Second quarter adjusted revenue coming in 7.7 to 8.1 billion, missing estimates of close to $9 billion. That's perhaps why we're seeing shares down about 8.6%.
Yeah, there were some concerns that perhaps Micron would be a little bit cautious heading into these results. Certainly the thing everyone's going to be listening for in the conference call is anything that says about the high bandwidth memory products, which is really the driving force, the growth area in its business, because the DRAM sales, they're just kind of there. It's the legacy business, and there might be a little bit of a glut in that inventory.
Yeah, and it's kind of interesting, too. We talk about a company that is much more wedded to the consumer space relative to some of its peers. They have a much better mix in terms of what they're doing with enterprise customers, et cetera. And maybe that's why you're seeing the reaction. And then, of course, there's just the obvious, which is this is probably the wrong day to miss on earnings report.
And just adding on to that, second quarter adjusted EPS, that outlook now between $1.33 and $1.53 a share. That estimate was for $1.92. So just to keep in mind that lowered outlook for the second quarter. Also, the vibe after last quarter from Micron was that the consumer part of its business was actually slowly going to improve. So this definitely a hit.
And I guess to your point, I don't know if it was you or Scarlett that made the point earlier about this idea of sort of what actually is the next catalyst. And you kind of forget, not only Micron, but you get FedEx, you get Nike, you get some pretty consequential companies reporting this week. And if they have misses, particularly if there are major misses here, are we going to see an additional sell-off here as people get concerned about the state of the market?
All right, also seeing that it's the worst post-Fed day in 4 years. So, again, just giving a little bit of perspective.
Keep that in mind when you do your gainers. I'm just throwing that out there.
Be kind to me.
In case any of those gainers
are they all gainers today, Carol?
In case they're
it wasn't
anything
easy.
red.
It wasn't an easy
screen.
task, and I waited till kind of after the Fed decision. So maybe I should just move along. Nvidia was up 5%, and it was a top gainer. In the NASDAQ 100. Be kind, be kind. It's down about 1%. So it's been down, 5 trading days in a row. Let's just move along. I'm just moving along. Here's something that you cannot dispute. Quantum Corporation. Yes, it's a microcap company. Yes, we did see a couple of trading halts today. The stock at its highs up 170%, finishing the day with 153% gain, $60 and change. It's about a $238 million market cap. At 19% of the float is short reported. It was out with a press release noting it's developed a new file system. It gets a little wonky and a little tech wonky, if you will, but it basically supports storage capability of NVIDIA. So I feel like tied to NVIDIA, you often get a little bit of a kick. And this one, really excited. It's actually for Alex, who I did not know had 2 pairs of Birkenstocks, but well, lo and behold, she does.
That's nothing compared to my 16.
No, I know. But my Birkenstocks are not on brand for me. Like, this is not something I would normally think of when you look at, the heels that I normally wear.
All right. So up 11% at its highs, finishing the day, holding on to about a 2% gain here. The company reported fiscal fourth quarter revenue and earnings per share exceeded expectations, issued an annual outlook that analysts described as solid. It's, soaring in the last quarter, this company. So, and this is one of our standouts in today's session. So now over to Tim, who had a lot to choose from.
Yeah, the easy job today, especially when we started to hear from Jay Powell. I do want to start with shares of Tesla, which were down as much as 11% in the session today. They just started tumbling following Jay Powell's press conference. Finished the day down 8.3%, still up more than 80% since Election Day, guys. So we do have to look at this one still with a grain of salt. But some of that euphoria, some of that has been pulled away. Also, shares of Broadcom finishing the day down by 6.9% today, down for a second day in a row following Friday and Monday's rally when shares moved higher by a whopping 38%. After yesterday's decline of 3%, it's down more than 10% from that all-time high that it did reach on Monday post-earnings. And finally, Sezzle, it's the buy now, pay later firm. It's about a $1.3 billion market cap out of Minneapolis. Shares just fell more than 20% after Hindenburg Research said in a post on X that it's short the company. A representative for Sezzle did not immediately respond to requests for comment. Shares falling 23% today.
All right, I'm going to the bond market, and then we'll get to some breaking news. The bond market had an incredible day. The sell-off across the board, it was the belly, though, that really felt the brunt of it. Those yields up by about 10, 11 basis points. So superlatives, there was a lot to choose from. The 2-year yield moving the most since of October. You also had the 10-year yield, the highest since May of 2024. You had a sell-off in the TLT. That's, of course, the ETF that tracks the 20-year. So it was very dramatic in terms of the slide that we saw within the bond market. We do have some breaking news, guys. I just wanted to point that out. Fox News says that Trump says he is against the stopgap bill. So.
Yeah, the stopgap bill.
This is a big deal. I mean, we're facing a deadline, on Friday, December 20th, whenever December 20th is. And we had heard rumblings earlier that at least congressional leaders, Republican leaders, were pushing back against this. And now, of course, the president-elect coming in here. I wonder if this is going to add to some of the pain. You're actually seeing futures in the post-market trade on the S&P now extending their declines by at least a half percentage point.
So I think this answers the question whether the sell-off will continue into tomorrow because of this headline. The idea that a government shutdown would be in play once again is not something that people have been pricing in at all.
I also think it also, Elon Musk, right, making comments earlier, and I think we were all questioning, does he speak for the president? Does that mean, this is kind of what's to come? And it just kind of says a lot about kind of Elon.
But it gets to this issue, too, of Jay Powell was asked repeatedly about how they're sort of factoring in some of these Trump policies. And, of course, he's not president yet. And so I can understand why he doesn't want to answer that. But to say we're just looking through it or we're going to see through it is like, what are you talking about? Well,
I think that he has to say that because, the president-elect is not president yet, and we don't know to what extent he's going to implement the policies that he's talked about at this point. Is he using sticks? Is he using carrots? Is he, is it all talk? What's going on here?
But also, when has the market moved, though, on funding issues, guys? We've been dealing with this forever. And it was, 2012 was when we saw? No, went back. Where did we see the downgrade?
2011.
2011, thank you. So it was 2011. That was the big moment, right?
Yeah.
But we've had these shutdowns all the time. I can't believe that this is going to move the needle on that end.
No, but we've got a lot more debt out there, too.
But I think, isn't it sort of the broader, the kind of the totality of it all, though? Alex, the idea that it's not necessarily just this, but it's all of these sort of events kind of coming together.
Also, it's not just in the U.S., right? You look at what's happening in Brazil, you look at what's happening in Canada, you look at what's happening in Germany, what's happening in France. All these G7 countries are dealing with fiscal issues and whether they can kind of sustain their spending.
Yeah.
Well, so much for a boring Wednesday.
All right. Well, Merry Christmas, everyone.
Merry Christmas.
And Micron's getting hit.
Move to cash and go
now?
home. All right, guys. Yeah, and Micron, as you said, Alex, still getting hammered. So we'll watch that into the Thursday trade. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We'll see you again, same time, same place tomorrow for the closing bell.
All right, stick with us. A lot more coverage coming up here on The Close. We're going to talk about what to expect from the Federal Reserve next year. A conversation up ahead with Ann Sonders over at Charles Schwab, as well as Tom Hoenig, former Kansas City Fed chief. Stick with us. This is Bloomberg. Back to the close. Romaine Bostic alongside Alex Steele and Scarlett Fu. We heard from the Fed just about 2 hours ago, and the market reaction to what they had to say was extreme, to say the least. One of the worst days for the S&P in months.
Yeah, if you just look at some of the numbers on the scoreboard here, I mean, the S&P ending down by 3%. The semis getting hit hard, but also it's really the small caps and the Russell that were smoked by the price action. But the dollar is the one thing that was up, you guys. The dollar, the Bloomberg Dollar Index, which is hurting pretty much every other currency, whether you're looking at the euro, looking at the pound, at the Brazilian real. You know, the central bank definitely tuning into that.
Yeah, absolutely. The worst market day, worst day for stocks on a Fed day since March of 2020, which tells you something. You mentioned semiconductors under pressure. Look for that to continue into trading tomorrow after Micron, the biggest memory chip maker, came out with a forecast that disappointed. Second quarter revenue outlook missing analyst estimates because of sluggish demand for its main chip, the DRAM chip, smartphones and personal computers. Yes, the whole outlook for its AI chips is doing well, the high bandwidth memory products, but that's a small part of its revenue base right now.
Yeah, Micron down 11%, still awaiting some earnings out of Lennar later this afternoon. We'll bring you full coverage of that as soon as we get it. Meanwhile, we recap what we learned out of the Fed, a 25 basis point cut, but the dot plot showing that expectations for further rate cuts, those expectations coming down, and the expectations for inflation, that's going up. Here's what Jay Powell had to say.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
And Jay Powell also noting that 12-month inflation readings, in his view, now moving sideways. Ann Sonders joining us right now, Chief Investment Strategist over at Charles Schwab. And Ann, what was most surprising to you, what we learned from the Fed today or the market's reaction to it?
Well, the market reaction was quite extreme. I don't think that this was a big surprise. We actually were of the view that there was justification for the Fed pausing at this month's meeting today. Now, expectations were such you were at about a 98% probability. You had the Timorous article that came out suggesting the Fed was going to do something. But it was, I think, pretty easy to expect a hawkish cut given stickiness in inflation and relatively resilient growth. I guess what the market reacted to was the cutting in half of the number of rate cuts expected in 2025, not to mention the fact that you had a dissent this time. And it was an interesting dissent because, it's a brand new president in terms of the Cleveland Fed. So it was an extreme move on the downside. But we were already seeing a lot of churn and weakness under the surface, really since the election. It's just masked by until today, strength by the Mag 7.
Right, and just took out the legs from them, and then there you go. Now you have negative breath versus positive breath at the end of the day. Ann, it was clear from the presser that there were some Fed officials who were looking at potential policy changes as a way that their economy and growth and inflation forecast was shaping up for next year. How then do you manage your asset allocation when there is so much confusion?
Well, it's not just confusion around the path of Fed policy, but confusion around government policy. And that there were so many reporters that tried to flesh that out from Powell, but he's in a position much like the rest of us, which is, the ultimate shrug emoji, because particularly in areas like immigration, like tariff, and the playbook that we have from 2018 with regard to tariffs, we just don't know when the announcements are going to come, whether this truly is a negotiating tactic or whether they will go to the extreme. It's hard to argue against the idea that tariffs, all else equal, put downward pressure on growth. They put upward pressure on inflation, and that arguably is something that came into the mix in terms of summary of economic projections, and the bias now much more in favor of the risk of higher inflation relative to lower inflation. And that was a big switch from the September dots plot and summary of economic projections. So I think that was embedded in market weakness today, too.
I love the fact that you brought up the shrug emoji, because Alex and I were saying there are so many of his answers pretty much amounted to that. When it comes to the Fed's inflation target, he clarified that it is still 2%. It's not 2.5%. It's not 2-ish%. What is your confidence, though, that that's what it's going to stick with, given that there's so many things that are evolving and will evolve in 2025?
I don't. It's hard to have confidence in a metric that is, at least near term, likely to be driven by government policy, particularly tariffs. Yes, I mentioned the 2018 playbook. The difference, of course, is that in 2018, the pro-tariff folks will say, well, it didn't lead to inflation. Well, they were much more targeted. They tended to be in intermediate goods. They were much shallower in terms of percent, and we didn't otherwise have an inflationary backdrop. Obviously, a very different situation today, not to mention broader, larger tariffs targeted on imports from multiple countries. What we did see in 2018 is that tariffed goods did see a big surge in inflation relative to non-tariffed goods. But we just don't know what 2025's playbook is going to look like. But again, it's hard to argue that the bias isn't up, at least near term, in inflation. Trying to calibrate policy, and to the first part of your question, trying to trade from an asset allocation, tactical or otherwise, around that, I think it's a really tricky exercise. I think you want to sort of stay close to your sort of benchmark strategic asset allocation weightings, but really take advantage of volatility for maybe portfolio-based rebalancing, as opposed to waiting for the calendar to dictate rebalancing.
And then that gets into the idea, Liz Ann, as to whether looking through some of these issues, meaning the uncertainty around the Trump administration, the potential volatility, and obviously the potential inflationary impact. I deride Jay Powell for saying he's looking past it. Maybe that's what he has to say. But is there a case for investors to indeed look past it, certainly if you're a bottom-up stock picking type of person?
Well, again, there's the timing issue. So with regard to tariffs and immigration, that can be done via executive order. So that is near term. There'll be some point where we have more clarity and we can start to look past that, particularly to the end of the year, where you have the potential to start to see some more of the pro-growth policies, whether it's on the tax front or the regulatory front. Those require congressional approval, though. So we're talking about different animals here in terms of timing and in terms of the process. I think what we are likely to see is a focus on fundamentals, that connectivity between fundamentals, quality-based fundamentals, trajectory in terms of earnings, exclusive of any variability associated with government policy. I think that's where the focus is likely to be, is where will those fundamentals be maintained with that growth bias, with that profitability, strength of balance sheet, interest coverage, exclusive of concerns about policy uncertainty.
So, Liz Ann, where does that leave small caps and mid caps?
Well, I think the move up from, sub 3.8 to more than 3.5 on the 10-year today was certainly a big part of why you saw the big turnaround in small caps to the downside. Many smaller companies, particularly the zombie companies, there's more variable rate debt, and they are more at the mercy of what happens on the long end of the spectrum. And I think that will continue to be the case, that small caps will be at the mercy of the move in the bond market. And so I think you have opportunities. But what we have been saying is when you go down the cap spectrum looking for opportunities, do not sacrifice quality. We had a low quality trade that kicked in the last month or so. We were saying fade that low quality trade down the cap spectrum. If you're going to go down the cap spectrum, absolutely stay up in quality.
So, Liz Ann, at the end of the day, how much do you read into today's sell-off in stocks and bonds? And does it set the tone for the remaining days of 2024?
Well, there was some signs of some churn under the surface. If you look at the NASDAQ, obviously the market has done really well since Election Day, but the average member maximum drawdown within the S&P is negative 9% just since the election. It's negative 21% in the NASDAQ just since the election. And that doesn't include today. So we were seeing some underlying weakness. It was just masked by what the cap-weighted indexes were doing. I think that type of churn under the surface could continue. We may continue to see some catch down by the recent sort of high momentum leaders. I would look for the point where you start to see some grinding better performance under the surface, much like we started to see back in the mid-July period of time. So that's what I'm keeping a close eye on as we go through this process of weakness, even if it's only a one-day phenomenon. I have no idea whether that's the case.
Well, but that kind of circles us back to corporate earnings, Liz Ann. I mean, you mentioned what we saw earlier this year when some of the same fears materialized, and then when companies started to report, at least the larger cap companies, all was well, relatively speaking. And I do wonder if maybe we see a repeat of that, where people do rush back to some of those big tech, or just big cap names, not just tech, but big cap names, those that have proven to have the cash flow, the revenue, and of course the profitability to justify their valuations.
I think you're right, Romaine. It's not just profitability, but profit margins. So expectations for calendar year 2025 earnings, both for the S&P, but also down the cap spectrum in an index like the Russell 2000, are relatively lofty. In the case of the S&P 500, those fairly lofty double-digit kind of gains in earnings are predicated on record-breaking profit margins. The good news is that forward 12-month profit margin estimates continue to go higher. If that is maintained and you continue to see decent productivity numbers, then I think you're okay in those segments of the market where you've got that profitability profile. But I think you're right. I think that trajectory of profitability, and in particular, maintenance, if not growth in profit margins, is really key to the story in 2025.
All right, Liz Ann, really appreciate your joining us today. Fantastic insight from Liz Ann Sonders, Chief Investment Strategist over at Charles Schwab, on this sell-off following the Fed meeting, the worst Fed day reaction in the stock market since March of 2020. We're keeping an eye on earnings. As Romaine mentioned, corporate earnings still taking place. Micron shares plunging in the after hours, down 15% after its second quarter revenue forecast. Its forecast for this current quarter missed projections by about $1 billion due to sluggish demand from smartphones and PCs. Let's bring in Pierre Ferragu, head of global technology infrastructure at New Street Research. The firm has a buy rating on Micron with a $155 price target. So Pierre, explain to me what it is about these results that are so disappointing when there was so much optimism built in about the high bandwidth memory products. It turns out it's the legacy business and the numbers related to that is accounting for the big drop today.
Yes, exactly. I think the memory market at the moment is extremely polarized. On one hand of the market, you have AI infrastructure that is consuming as much memory as it can in a very specific, very leading edge form factor, the HBM, the high bandwidth memory you refer to. And that part of the market is doing incredibly well. And data center demand represents more than half the DRAM market today. And growth there is very strong and is only going to strengthen next year. Mm-hmm. On the side of that, you have traditional markets, which are the PC market, the smartphone market, that have gone through a very unusual pattern in which you've had a very, very strong cycle of inventory correction in the last 18 months, we even say in the last 24 months. We came out of this inventory correction last summer, but end demand, consumer demand for smartphones and PC, went well below what the market was expecting. Mm-hmm. You remember that smartphone manufacturers, PC manufacturers were like, AI is going to drive a refresh cycle. Mm-hmm. People will want to buy AI PCs. This is not happening. And that's creating a second air pocket in these markets, but it's a short one because a big inventory correction has happened already. And we are going through a second, very, very shallow inventory correction. And in memory, as soon as you have too much chips to sell, your margins are under pressure and you can miss fairly significantly this quarter, $1 billion is a lot.
So I know we haven't had the call yet or anything that you've seen, but it seemed like in the last quarter, they felt much more positive about those consumer electronics. Do we believe their forecast that the back half of their fiscal year now will really finally see that turnaround?
Yes, I agree with you. The quarter is very disappointing, the guided quarter they give compared to what they said 3 months ago. So I think management probably was betting on stronger consumer demand, stronger end demand than what we saw. And so the direct read across of that is that consumer demand for PCs and smartphones is probably not improving at all. And on the contrary, it could be still disappointing. Now, there is so much a market like smartphones and PC can come down. We are already 10% below the levels of 2022, which means that we're going to have 1 or 2 quarters of very weak demand in this market, but then inventories will be flushed and things will have to come back to normal. So it's a very temporary weakness, yes.
So is there no hope, Pierre, that we do see maybe the data center business pick up a little slack? I mean, I was going through the numbers on the Bloomberg terminal. This appears to be the first quarter that I can recall where data center revenue actually made up more than 50% of sales. Is that not a silver lining?
This is definitely a silver lining, and we are actually very, very optimistic about that, Romain. Now, in memory, remember that when you manage your fab, you make a decision, and then the lead time for the manufacturing process to go across is like 4 to 6 months. So the problem is that today you have too many chips for smartphones and PCs and not enough chips for data centers. And they are very similar chips, but slightly different. And so manufacturers cannot use the extra demand from AI to absorb just now the excess capacity on the smartphone and PC side. It takes 6 months to make these adjustments. So 6 months out, you're 100% right. Next 6 months, we'll have to go through a bit of pain on margins and on volumes because of that.
All right, Pierre, we really appreciate it. Thank you so much for jumping on with us. Pierre Ferragu, head of global technology infrastructure at New Street Research. Here's a new stat for you guys. You're looking at the worst loss for the S&P on the day of a rate decision since 2001. That's something. All right, coming up, more perspective on America's home builder housing market. Lennar's latest quarterly results out in just moments. This is The Close on Bloomberg. All right, we are waiting for Lennar shares just out right now. We're looking at the shares down by about 4% after earnings came out with a miss of fourth quarter earnings coming in at $4.06 a share versus the estimate of $4.82. Also, revenue coming in light as well, under $10 billion. We were expecting over $10 billion. Norah Melinda, Bloomberg's stock market reporter, is joining us. She also covers the housing stocks and everything real estate. Quick blush at these numbers. What's your take?
I mean, it's not all that surprising. We've really seen a large rally. The home building sector has been high flying. We've seen it being so buoyant, and we are finally seeing a slowdown. This is obviously because we've seen rates that are so high, they're not coming back. And we're also starting to see a bit of increased competition from the resale market in certain areas. So that's really been something that people have really been keeping an eye on. But in terms of the actual results, there's a few things that people are looking at. Gross margin, which that can really be impacted by incentives. We're seeing a lot of these home builders giving out so many rate buy downs and giving out so many incentives that it's actually weighing on their margins there. And then also orders, of course, that's something that's in focus as we think about spring selling season, which is the most optimal season for the sector coming up. And then also rising land costs. I mean, we had Prashant Gopal, he's a colleague of ours, he released a story this morning that was talking about how Lennar has plans to spin off its land into a publicly traded REIT. So that'll be really great for Lennar as a company, but not surprising in terms of these results.
We talk about the forecast here for the fiscal first quarter. New orders roughly around 18,000. But interesting, you mentioned gross margin. They're forecasting gross margin of roughly about 19 to 19.25%, slightly below what we saw in the most recent quarter. And it gets to this idea here of pricing power and, more importantly, whether they continue that pace of building that they had set out in the past.
Most definitely. That's what everyone's wanting to see, whether or not these obstacles that they are going through, if they can push past and actually see some growth to come. But people can really squeeze out more returns from this sector, that remains up in the air.
So going forward then, if with all this focus on gross margin, of course, gross margin disappointing for the quarter that did end, the focus then becomes on cost control and making sure that they reduce expenses in every other way while waiting for the housing market to kind of regain some of its mojo.
Most definitely. It's a balancing act right now that they're all experiencing. And of course, this has been a sector that so many people have bet on. But now we are seeing it pull back as people are really seeing the Fed taking a little bit longer in terms of bringing down rates and what the outlook looks like for rate cuts. That also impacts the home building sector.
Well, and actually, Powell got this question about the 30-year mortgage in the presser, just like how sensitive certain parts of the economy still are to Fed cuts or Fed hikes, because there's such a structural supply shortage of houses that it doesn't necessarily make a difference whether or not you're cutting by 50 basis points or 75. You're still going to have affordability issues full stop, which is exactly what's hurting Lennar's gross margin.
We're actually seeing a lot of analysts pointing towards single-family rentals as an alternative for those who are not able to actually buy a new house. They're turning towards single-family rentals, and so we're seeing the REIT space rising as a result of that sector dealing with some issues.
This is the idea, though, too, when we talk about the health of the housing market and how much it ties into the interest rate environment, particularly against the backdrop of what we learned today. Potentially fewer interest rate cuts next year than at least what the market had been pricing in. And I would assume, at least for right now, that's going to keep the cost of capital that these home builders are seeing kind of in that same bandwidth that they've had all year long.
Most definitely. That's something that they have to really regulate, and one thing that we're watching as we're moving forward. And of course, this is really the ramp up into spring selling season. So that's where eyes are right now and seeing how they can perform through this time period.
I'm really interested in the spring selling season.
Oh, I bet you
and me both.
For a friend.
Oh, for a friend. Okay.
So, yeah.
I bet you don't like that September cut coming all the way there, right? Hoping for non-January skip.
So, Norah, as we look ahead to the earnings call, remind us the distinction of Lennar. It's not a KB Home, which is for first-time home buyers. It's not a Toll Brothers, which is kind of a luxury builder.
Right.
Where does Lennar fit in the spectrum of home builders?
They do it all. So they do point toward first-time home buyers. They also do move-up buyers and a bit of luxury. They're one of those companies that kind of say that they do almost all-inclusive, if you will. So that's the type of company that we're looking at here. And of course, this is after we just heard from Toll Brothers not too long ago in the luxury space struggling.
All right, Norah Melinda giving us a closer breakdown of what we learned out of the home builder Lennar. Those earnings just crossing the wire, a miss on some key metrics and a forecast giving some concern here. Those shares lower in the after hours trade, and kind of fitting given what we saw during the cash session here with the S&P 500 having its worst day in months, and in fact its worst Fed day reaction since at least 2001, as those numbers are now updated. A 3% drop on the S&P, guys. 3.5% on the NASDAQ, and you've been pointing out this all day, Alex, more than 4% on the Russell. Is this kind of the end of that small cap cyclical rotation?
It's a good question. Who knows at this point? I mean, the big question here is how much people are really going to be positioning the next couple of days rather than just kind of taking time off until 2025 and resetting.
Well, here's another headline for you. And Romaine, this goes back to your point. In a post on X, President-elect Trump and Vice President-elect Vance say that Congress should debate debt limit now, as in we're just going to pile on stuff while things aren't great, is going to be dicey.
And that sound you hear is everyone in Congress who's already away for Christmas laughing their heads off. But it gets to this idea, though, too, of the volatility, right? And I think Jay Powell was peppered with this question in various forms, and he dodged it, as he typically does, in various forms. But this idea that come January 20th, the world changes a lot in terms of how policy gets done in Washington and how the market is going to have to follow that policy. And for that matter, Jay Powell himself is going to have to follow that policy.
Right, and how the Fed kind of folds in everything. And as he admitted, some people folded in right away into their estimates, others haven't. It's a real mixed bag, and it doesn't inspire a lot of confidence in terms of how they're making policy.
Yeah, an interesting setup into 2025 as we close out 2024. A lot more coming up right here on The Close. Stick with us. This is Bloomberg. Welcome back to The Close. Today's 25 basis point rate cut by the Federal Open Market Committee here in the U.S. was widely anticipated. More notable, though, and not necessarily anticipated, was the update to the dot plot that signaled a more gradual and shallower path of rate cuts and expectations that inflation will reassert itself. Thomas Hoenig is joining us right now. He's Distinguished Senior Fellow at the Mercatus Center at George Mason University. He's also the former president and CEO of the Federal Reserve Bank of Kansas City and also served on the FDIC. All right, Mr. Hoenig, this is an interesting report because we talk about this idea of what the Fed did, but more importantly, how all of those members, not just the voting members, really all 19 members of this committee, really looking ahead to 2025. And there did not, at least based on the dot plot, appear to be any real consensus amongst them. Is that an issue to not have that consensus heading into the next meeting?
Not necessarily. I think it's a committee for a reason, and that is that there are different views, different perspectives brought forward. I think the more telling thing was the inconsistency in their actions. They're projecting that inflation is higher than it was going to be when they did this in September. The economy is stronger than they anticipated. The outlook is better than they anticipated, and yet, and they are looking at higher inflation, and yet they lowered interest rates. So you have a bit of a quandary that follows that, and I think that kind of brings into question credibility, and why I think you had some of this market reaction today. Because who knows when you get into that kind of with that kind of inconsistent actions. And that's what's really happened, I think.
That's such a great point, Thomas. Thank you for making it, because it also dovetailed with how the members looked at the potential policy from the incoming administration. And Jay Powell did say that some people did start to incorporate highly conditional estimates of economic effects of policies into the meeting. Some didn't, and some didn't say. How unusual is that?
Well, those projections are always based on personal views. You don't have a common set of assumptions, nothing like that. And so that's why I've never been a strong fan of the projections, because they can be as misleading as helpful. And I think today is one of those examples where it's not being very helpful. I think the fact of the matter is, I was not at all surprised by the cut. No one was. But I also am disappointed by the cut, because clearly the economy is stronger than was projected when they said we were going to do a 100 basis point cut this year. The inflation is higher than they thought it would be. And the uncertainty is greater than it was, and yet they cut rates. And they have to look forward to a new administration coming in. There's going to be a lot of policy discussion between now and then. So I think I don't understand their moves. I think they should have waited, learned more, and then talked about what actions to take next. And I'm not sure further cuts are even warranted.
So, Thomas, it sounds like you're saying that they didn't need to cut, and they kind of only did it because they were under pressure by the markets to do so. Am I reading that right?
I think that's a fair conclusion. I mean, their own projections show they didn't really need to cut, and that's the issue. The other thing is they say they're restrictive. Well, when I look at where they are at now 5.25, and inflation is 2.5, in that at least 2.5. I'd say that the real rates are 2% or less. And if you look at then what the so-called equilibrium rate, the natural rate that they talk about, their R-star, the equilibrium rate for the interest rates, if you look at that, I've seen more and more economists come out with a higher equilibrium rate, somewhere closer to 2% than 1.5 or 1%. And so there's all this information that suggests that policy is not overly restrictive, not even particularly restrictive right now, and yet you're cutting rates. And that, I think, now the market has to figure out what's going on, and that's not easy.
Well, on that point, though, Tom, just to kind of push back on that, I mean, the market, of course, is looking at this based on where the Fed rate is, and then, of course, looking at where markets rates are. There's still a pretty big gap there. And, of course, if you take what's on the dot plot, that gap widens. Is that not an indicator of restrictiveness?
Not when you think about it in terms of, in my view, when you look at the so-called natural equilibrium rate, and you look at where fiscal policy is, the amount of spending going on, the size of the debt, the need for investment funds for new technologies, and also for reshoring manufacturing, the natural rate is probably closer to 2% or better. And then the real rate, which they have right now, taking the policy rate of 4.25 minus 2.5%, you have a real rate that is less than potentially where the natural rate is, and yet you're easing. And you knew that going into this meeting. So I think that the rates now, the longer rates are up, but that may be more a reflection of the longer rates are finally coming into play because the Fed is suppressing the yield curve less, and that's an issue.
Do you feel, though, that that's intentional? And if so, is this a reaction, though, to what's been happening with inflation, or is this more on the labor dynamic of the Fed mandate?
You mean in terms of their cut?
Yes.
I think they're focusing. I don't like to use this word because it's often used too easily, but that is, I think the Fed has a bias towards ease. They want to make sure that the employment numbers stay strong. They're buying what they call insurance by making this cut to make sure the economy stays stronger. Now, they also put in this message that they're going to slow down their increases. The market's reading that because the market, lower rates, asset values go up. This means that the asset values are going to be going up as much. There might even be some containing of that. And that, of course, disappoints the market, and that's why you see the market reacting the way it is.
Thomas, what do you think the risk is that we'll see a reacceleration of inflation next year?
I think they're fairly good. First of all, you're going to have a strong move to keep tax rates where they are, not going up. You have, I think, some pressure on tariffs going up. That'll be temporarily inflationary as I see it. And you see a lot of demand in the economy, and now the rate has been cut. So the risk of inflation going up, I think, is greater now than it was before they cut the rate. And I think the outlook would suggest that, unless there's some kind of a surprise shock into the economy, and that is not on the horizon, at least at the moment.
Would it be fair to say, Thomas, that you disagree with a lot of what Jay Powell had said and what the committee decided, but one area that maybe you might agree on is his characterization of the economy? I expect another good year for the economy. I think it's pretty clear we've avoided recession.
I think it's clear that we've avoided a recession at this point. The outlook is positive, and now more positive with this rate decrease. However, now there are some new issues being brought up, and that is, will we see a reacceleration of inflation? Will we repeat some of the mistakes of the 70s that people talk about? Those are now more on the table, and I think you will see that reflected in the market today.
So, Professor, I do want to pick your brain a little bit, though, about the process of what happens behind closed doors. Obviously, you have a lot of insight given the decades that you spent working at the Fed. This idea of data dependency, and as we heard from Jay Powell today, the idea of not necessarily trying to factor in things that haven't happened. He was asked repeatedly about Trump administration policies, and he made it clear it's hard to really factor that into monetary policy until those policies are actually implemented and you see the effect. But don't you guys, behind closed doors, don't you talk about these hypotheticals? Isn't that what you do? Isn't that what Jackson Hole is all about? Or am I just misinterpreting it?
You're not misinterpreting anything. I think you wouldn't be responsible if you didn't think about what the consequences of possible future actions are. What happens if we have tariffs? What happens if we don't have a continuation of the tax cuts that were in play? What happens with the international environment that we're in? Those are all things. Now, when you have to finally make the decision and you don't know what all those what the future holds, then you say, all right, here's what I know right now. Here's what I think the outlook is, and that is they're probably assuming that the tax cuts will be extended. They're probably assuming that the tariffs will be more modest than what people are fearing for. But they are also underestimating the inflationary pressure behind the economy, given that they moved today, or they were more afraid of disappointing the market by not cutting rates than they were from cutting rates. And I think whenever you try and satisfy the market, you're going to get bad events like we are seeing today with the market coming down as it did.
Yeah, ironic in that, I suppose, in that way. Thomas Hoenig, really appreciate your joining us today. Thomas Hoenig is Distinguished Senior Fellow at the Mercatus Center at George Mason University. And of course, he previously did serve as Vice Chairman of the FDIC, as well as work at the Fed. Now, during today's press conference, Fed Chair Jay Powell had this to say about the labor market, the other part of its dual mandate.
I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And, that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and, we want to keep it that way.
All right, joining us now to discuss is Claudia Sahm, Chief Economist at New Century Advisors. Claudia, we just spent some time talking about inflation and how Thomas Hoenig thinks that inflation might be a risk in 2025. Let's talk about the labor market, because Jay Powell's characterization of the labor market as it's cooling, but not in a quick way, that raises concern. I'm curious to get your perspective. Is the labor market, the strength of it, an underappreciated risk right now?
The fact, and Powell mentioned multiple times, there is cooling that continues to happen. Well, that's not the right direction, right? Or at least, or there has not been a case made, right? They're saying we don't need to cool the labor market off more. We're not in the labor shortages. We're not in the overheating. Not a risk to inflation. So what we need to understand that dynamic, is the cooling going to just turn off on its own with interest rates still elevated? I mean, the Fed is still putting downward pressure on the economy. There may be a lot of other factors that are putting upward pressure on the economy and keeping us going. But there is this, and Powell was asked a little bit about this, what what makes that, not be a risk factor? So I don't think the labor market got a lot of attention today. I think the projections that the median officials were writing down were very sanguine on the unemployment rate path over the coming years, and very, very pessimistic on the inflation path. And so that's it. But we know this Fed, like we have watched this Fed. It is one that understands the dual mandate, and it's very data driven. Everything's going to hinge on what do we actually see next year. Mm-hmm. I mean, these projections are not that informative. It was what are we facing?
Well, not that informative. I agree. I mean, some of these numbers, as we know, and they can be squishy. And of course, we know they're going to change to some extent or another in about a couple months' time. I want, though, Claudia, ask you the question here. Mm-hmm. When it comes to the labor market, and when he was asked about it, he didn't seem to think that monetary policy, and maybe I'm misinterpreting, itself was actually tamping down the labor market side of the equation here. Why would he think that?
I mean, interest rates are elevated. I mean, we can argue until the cows come home about what the neutral rate is, and at the point in which the federal funds rate doesn't affect the economy, but we're still, now we're 4.25%. This is elevated relative to the period coming into the pandemic by a good bit. We've closed a lot of distance this year, right? Taking a percentage point off of the rate, but we should remember the Fed was very aggressive when it started fighting the interest rate, or fighting inflation. We had 4 75 basis point meetings in a row, right? So we've, taken a meeting and a half off in, this year. So I think there is still pressure, and we look at interest rate sensitive sectors and you can see the effects there, and those have workers too. So there's something there, but I hear you. What is happening in the labor market, and this has been true for inflation as well, is we are still working out some very complicated dynamics that we have gone through since the pandemic that we just didn't understand. We've had massive swings in the labor market. We've gone from labor shortages, mass hiring, to now the hiring rate is subdued. Well, is that a reflection of a real slack demand? Probably not. The economy looks pretty good. Or is it just there was a lot of hiring done, and they're just getting the productivity lined up, and this is just kind of sorting through the aftermath of those prior periods. And in that case, that's not something for the Fed to worry about. That is a process working itself out.
Claudia, in your experience and your years of working on labor dynamics, how quickly can the labor market cool once it really starts to cool?
It can go pretty fast. And the work that I've done, one of the most important things to underscore is the U.S. labor market is very large, and is often slow moving. So what look like relatively small increases in, say, the unemployment rate that really don't look like a big deal, they can snowball. And once they get going, so you get the emotion, it's very hard to arrest that dynamic. And that was part of what the Fed was reacting to when they got going this year with the cuts. Not that like we were in the danger zone with the labor market, but the unemployment rate was drifting, and it was causing some concern, and they wanted to keep the strength in the labor market. I fully expect that we will have a moment like that next year. I'm not saying we have a recession barreling down on us. I'm not saying, that things are just going to come out of left field and really upend the labor market. But this slowing process is in all likelihood going to probably create a couple more scares about, how resilient is this labor market. And you lose the labor market, and then it really starts to fall apart with the economy.
So what should we be looking for? What are the first signs of cracks in the labor market? What will you be looking for?
So one thing that is unusual about this cycle that I think is important to keep an eye on, we had a lot of discussion this year about how much labor supply we've had into the country. And the last year's big growth that we've seen, an important part of that is coming from we have more workers. Not all of it, but a lot of that came from immigration. Coming into, we had, a really big increase in immigration that helped solve a lot of the labor shortages. Well, that time has passed. And we don't have to go into the scenario of mass deportations. Just getting back to immigration levels that were similar before the pandemic, that'd be a pretty big slowdown. And it's that whole, the labor supply side of the economy is just really hard for us to get a handle on. And it has huge implications about whether it's inflationary or whether it's not. So I think that's one thing I'm really looking for, is what the immigration, how it plays out. going into next year because we've already seen in the data slowing in the immigration.
Claudia, we really appreciate your time today. Thank you so much for your perspective. Claudia Sahm, chief economist at New Century Advisors. All right, guys, the week's not done because there's actually a lot of stuff happening tomorrow in particular. Pre-market, we do get earnings like CarMax, Darden, Conagra, and Paycheck. And believe it or not, I'm really interested in the BOE rate decision tomorrow at 7 a.m. Eastern time.
Feels like an afterthought after what we got with the Fed, but that's only because of the market reaction that we got today.
Yeah, 8:30 a.m. Back here in the U.S., though, we do get an update. These are the quarterly updates on GDP. I think that's the third update we get, as well as the core PCE price index. And those weekly initial jobless claims, of course, just talking about the job market there with Claudia Sahm. It'll be interesting to see kind of what that trajectory has been, at least on the averaged out jobless claims number.
Yep, and then existing home sales, right? I mean, we get those numbers out as well. No doubt we're going to see some good data on that in terms of the details. But you're looking at Lennar still getting hit after disappointing earnings.
And this isn't on our calendar, but Luigi Mangione, the suspect in the fatal Manhattan Midtown shooting of the UNH executive, he will appear in court on Thursday in Pennsylvania.
All right. Also, keep an eye on earnings that could potentially move the market. FedEx and Nike, two big ones there. Of course, two different slices, if you will, of the economy, but maybe a good look into how healthy the consumer is right now. Take a look at Nike. Wow, down 37% on a year-to-date basis. Be interesting to see if they could turn that around with tomorrow's report.
And both of them, I feel, will be a really interesting read on what they might say on the call in terms of tariffs and any kind of risks there. Now, FedEx has its idiosyncratic stuff it's going through, as well as the macro. So getting that read will be quite interesting from both.
So does Nike, for that matter, right? I mean, it hasn't figured out its strategy really just yet.
Full coverage of all of that tomorrow, and of course, a discussion here about the supply chain issues affecting both of them. We'll be back tomorrow here on The Close for all of your market coverage. For your political coverage, stick around. Balance of Power is up next at the top of the hour, right here on Bloomberg.